The Japanese yen is now set for a much bigger move higher. This is the topic that I want to cover in today's Forex and stock market news. And in today's video, I want to outline the case for this over January and February. And also we're going to, at the end of the video, look at the technicals in the Japanese yen pairs. And I'm going to identify two of the currencies that I think offer the best short opportunity versus any bigger move higher in the Japanese yen over January and February. So today's video picks up with this Bloomberg headline from November. Yen carry trade that rattled markets shows sign of a comeback. Wide yield gaps and low volatility are driving the carry trade. Bearish wagers on the yen rose to 13.5 billion in November. The yen carry trade, an investment strategy that blew up in spectacular fashion this year, is regaining popularity. Japanese retail investors as well as leveraged funds and asset managers outside the country are estimated to have boosted bearish wagers on the yen to 13.5 billion in November from 9.74 billion in October. The strategy has been very profitable. Yen-funded carry trades that target 10 of the major and emerging market currencies have returned 45% since the end of 2021, compared with a 32% return from the S&P 500 index that takes account reinvested dividends. That drew in more and more investors, with yen short positions reaching 21.6 billion at the end of July, right before the furious unwind. So the first very important thing to note is the fact that we started to see a reemergence of the carry trade coming into the Japanese yen in November. So we're seeing once again very strong bearish bets and wagers coming into the Japanese yen over the course of November. And if we go back to the chart here, you can see that speculators who started to rebuild yen short positions in November were doing so, and specifically we're looking at Japanese retail investors, the purple bar. They're doing so at levels approaching the Japanese yen blow up in 2024. And before the Japanese yen blow up earlier this year, levels not seen since 2022. So we know what happened earlier this year when we started to see this kind of positioning to the short side in the Japanese yen. We had the yen shock, and this caused a sell-off in the stock market as well. But what happened previously in 2022 when we started to see this level of bearishness coming into the Japanese yen? Well, if I pull up a chart of the Japanese yen futures here, you can see we had the big yen shock in 2024, but look back to October 2022 when we started to see this level of bearishness coming into the yen once again. It was the bottom before a big rally in the Japanese yen to the upside. So we're back in terms of positioning to just before 2024, the yen shock to the upside, and before that, the October 2022 bottom in the Japanese yen. So this is important because we're starting to see the same sort of short positioning coming into the Japanese yen over the course of November that we saw previously before the yen blow up earlier this year, and at the bottom, the October 2022 bottom in the Japanese yen. Now, the problem with overly bearish positioning is all it takes is a catalyst to start to unwind that, and things can quite quickly spiral out of control. And after such negative bearish positioning in the Japanese yen throughout November, what happened right at the end of November? Well, you can see from this Bloomberg headline, the yen breached the key 150 level, but Tokyo inflation fuels BOJ bets. And an unexpected surge in Tokyo inflation at the end of November has led to swaps pricing in more than a 60% chance now of a rate hike in December. The Japanese currency surged as much as 1.2% to the strongest level since October 21st, following Tokyo consumer price data that came in hotter than expected. Expectations of a narrowing of the difference in US and Japanese interest rates, and by extension yield differentials, will make the yen carry trade, a popular strategy where investors borrow in Japan and then deploy the funds in high yielding markets, less attractive. Will make the carry trade less attractive. And so what we've seen now is we've seen overly bearish position in the yen into November, and then those short traders get hit with hotter than expected Tokyo CPI right at the end of November. And what happens? It causes the yen carry trade to become less attractive, and we started to see those sellers of the yen pull out of their position, and it's already started to cause an unwind to the upside in the Japanese yen. So why is it less attractive? Why are these shorts who were piling up in November suddenly reversing and closing their positions, and we're starting to see the yen moving in the opposite direction? It's because hotter than expected inflation requires a monetary policy response. We move over to this headline with BOJ's Ueda saying that a rate hike is getting nearer with wage trend key. Yen strengthens after Ueda's comments in Nikkei interview. The Bank of Japan Governor Kazuo Ueda said interest rate hikes are nearing as inflation and economic trends develop in line with the central bank's forecast, helping to strengthen the yen without explicitly supporting an increase in December. Ueda stated that we will adjust the degree of monetary policy easing at the appropriate time if we become confident or certain that the economy will move as forecasted by our economic and price outlook, particularly that the underlying inflation rises towards 2%. The next rate hike is nearing in the sense that economic data are on track. And if we pull up the Tokyo CPI chart, you can see on a year-over-year basis, we're back above 2%. And not only are we above the 2% target now at 2.2%, but we've started to bottom, and it looks like we're going to be making our way towards 3% in the Tokyo inflation gauge. So you can see what's happened here. We've started to see the yen carry trade picking back up. We've seen shorts piling in. And what's happened is right in the same month as this has taken place, we get hit with that hotter than expected inflation. The monetary policy response comes from Ueda. He talks about raising interest rates. And what does that do to bonds? Picking up with the headline, Japan firms rush to sell bonds as BOJ December hike bets grow. Japanese corporate borrowers are selling bonds at a faster pace as speculation grows the Bank of Japan may raise interest rates again next month. Issuers have accelerated their borrowing plans ahead of the BOJ's next interest rate meeting on December 18th, 19th. Speculation about a December rate hike has intensified this morning after data showed Tokyo inflation accelerated. And whilst Ueda didn't explicitly commit to a December hike, market expectations for a rate hike have roughly doubled this month. Now remember, the bond market is a sophisticated market. It tends to be a leading indicator for other markets, especially stock markets. And if the Japanese bondholders are selling their bonds, this tells you that regardless of Ueda committing to a December hike or not, the bond market believes it's most likely coming. Because if they're selling bonds, it's because they believe rate hikes are coming, and this is going to push yields up. And as we can see, Japan's yields rise as Ueda's comments bolster hike expectations. Japan's 2-year yield climbs to highest since October 2008. Overnight index swaps priced in a 60% chance of a December hike. The 2-year yield climbed to its highest since 2008, and the 10-year yield rose 2.5 basis points to 1.075%. After Ueda's remarks in an Nikkei interview suggested a hike may happen soon. And this is what the bond market thinks of this. Overnight index swaps are pricing in a 60% chance of a December move, with the probability reaching almost 90% by January. So we can see the scenario here. Big Japanese yen shorts have built up. They get hit with hotter than expected inflation right at the end of November, above the 2% target. Ueda has to come out of a monetary policy response. As a result, bond traders start dumping. This pushes yields higher, and it causes the Japanese yen to rally. Now you might be saying, well, over the back end of December into January, we have a strong dollar, so this is going to put downward pressure on the Japanese yen. However, seasonality suggests we may actually see the dollar just chopping around and moving sideways, which would also help to push the yen higher over this month and into the first part of 2025. You can see the dollar faces treacherous December on Trump rate risks. The US currency has weakened in 8 of the last 10 Decembers. The US currency has advanced about 2% since the November 5th election, but seasonality shows the odds are stacked against it from here. The greenback posted losses in 8 of the last 10 Decembers, often a victim of year-end portfolio rebalancing flows and the so-called Santa rally that emboldens traders to sell dollars for riskier assets like stocks. So what we're seeing is, if we're going to, and it's not guaranteed, it's not every single December without fail, but most Decembers we start to see, because of those year-end portfolio rebalancing, we start to see the dollar kind of weak. I mean, it might not sell off hard, but if it just chops around, this is going to provide more fuel for an upside move in the Japanese yen, because it works as that kind of counterbalance. When the dollar is higher, this is suppressing the yen. But if the dollar is not moving over December and into January, this can unpin further upside in the Japanese yen. So I want to head over to the charts and have a look at the technicals in the yen pairs. But first of all, what currencies could offer the best short opportunities versus the yen over December and into January and potentially February? We can see from this headline that hedge funds pivot to selling euro against the yen on Japan rate bets. Nomura, JP Morgan seeing macro fund preference to sell euro for yen. And this is because France's no confidence vote is emboldening currency option traders to short the euro versus the yen. Since the start of November, there have only been 3 trading days when the trading volume has exceeded $3 billion, with 2 of these being in the last week. So hedge funds are starting to enter into a short euro-yen trade because of the no confidence vote that we're seeing in France. And I would imagine, although the article didn't say that, also the weakening economic conditions we're seeing in Germany. So the euro versus the Japanese yen is definitely something on my radar for a bigger move to the downside if we continue to get the yen appreciation, as it looks likely over the next month or two. And the second currency to keep an eye out for is the New Zealand dollar. Why? Well, you can see from this headline that New Zealand recession risks grow as export volumes fall again. Exports of goods dropped 1.8% in the third quarter from the previous 3 months. Imports rose 3%, meaning net exports, which are comparable to measures used in the gross domestic product report, fell 4.8% from the second quarter when they dropped 7.9%. And for those of you who have taken the GMT trading course as a member of GMT, you will know that net exports is a component within GDP. So as net exports come down, this actually decreases GDP. And this is why this article is talking about a potential recession in New Zealand. Now, if there's a recession in New Zealand, what does that mean? It means there's going to be a monetary policy response. They're going to have to weaken the New Zealand dollar to stimulate the economy. And because of this, hedge funds turn bearish on Kiwi as another large RBNZ cut is seen. Economists see the RBNZ cutting by 50 basis points in February. And now, hedge funds have swung to a bearish position on the New Zealand dollar for the first time in a year. Amid growing expectations, the central bank will keep rapidly cutting interest rates. And you can see from this chart that hedge funds are now net bearish on the New Zealand dollar for these exact reasons. So let's now go and have a look at the charts with the Japanese yen technicals, and we're going to see where this bigger move could start to unfold. And we'll be keeping special attention, of course, on the euro to the short side versus the yen and the New Zealand dollar to the short side versus the Japanese yen. Okay, so let's jump over to the Hedge analytics platform, and there's a couple of things that jump out straight away looking at the Japanese yen itself. The first is that, of course, big rally we had on the initial yen shock back in July, at the end of July, where we saw stocks selling off for about 3 days and we saw a big snapback in the Japanese yen. The first thing to note is we've started to see this unwinding of the short positioning that was taking place in November. Remember, we just went through this. We started to get more and more shorts coming in. The yen carry trade was picking back up, and that's referencing this drop here actually through October and into November. And then we start to get an unwinding of that. Why? Because inflation's picking up. We get the monetary policy response. Bond traders start to dump their bonds. Yields go up, etc. So it looks like we've had the initial rally, this downtrend, this positioning that we've seen traders coming into trying to continue the yen carry trade to the downside has started to unwind already. And it looks like we've got the first move up. Now, for those of you who like your wave counts, very often that first momentum is considered a one wave, and a second wave as a pullback is the opportunity to enter for what? A following third wave or a bigger move higher. So the first thing to note is we're starting to already, because of that initial CPI print and response from UADA, we're starting to see that yen carry trade unwinding. We're starting to see yen shorts covering their positions. The second thing to note is we failed to take out the low in the Japanese yen from the initial yen shock. So not only does this set up a potential one wave here, a second wave down, and then a third wave, but if we take out the prior high here, this actually kickstarts an even bigger third wave. And this is how you can get monster moves in markets. And the yen is a very volatile market anyway. So at the very least, I would expect to come back up and retest the high of the prior yen shock. But if we break with momentum, we could actually see a bigger third wave unfolding to the upside in the Japanese yen. In the near term, you can see on a rolling daily basis, we are extremely overbought. Once we get this reading, what does it mean? we're going to likely liquidate, very, very likely, almost 9 out of 10 chance over the next 3 or 4 days, 3 to 5 days, we're going to liquidate and we're going to start to see this near-term long positioning essentially booking profits and you get the pullback. So keep an eye on this. Coming up, we're going to go and have a look at some of the pairs now, but the 0.6582 is the lower bound this week. If we start to trade below this, that is where the Japanese yen itself becomes oversold intra-week. And very often what you get here with these levels, and for those of you who follow along with the weekly Forex forecast videos, the weekly stocks forecast videos, you'll know that this is essentially the buy zone during the week, and they update every week these levels. And of course we have the daily, the monthly, the quarterly, and the annual levels in here. But below the 0.65821, we become oversold intra-week. And when you get this first initial move, very often with these levels, the market is trending down. You get the first initial move, it takes out its second upper bound, which is what we saw recently with the Japanese yen pairs, taking out their gold levels. And that actually is a sign of abnormal momentum. It means we've basically got a trend change. And the levels reset, just like they have this week. And when you come back and you take out the lower bound, for the first time, having taken out a gold level in the opposite direction, in other words, it does this. The market's coming down, it breaks the gold level, the market resets like this, and then you test the lower bound over here for the first time. That is where you get your higher lows coming in, and also to the downside, you get lower highs coming in. So very often that setup, you break the gold levels and then the following pullback and test of the level in the other direction, the blue level, that actually sets up a one wave, a second wave potentially for capturing a third wave. So keep an eye on that. Those are the key levels for the Japanese yen as it currently stands this week. Okay, so let's have a look at euro yen then to the downside. This is a market highlighted for various reasons in today's video as a potentially very good candidate for allocating capital in if you want to try and take advantage of any rally in the Japanese yen. You can see also the yen shock causes this, what looks like an impulse wave, a one wave. And it's a one wave because it comes from a high. And the characteristics of the pullback or the bounce are choppy. Now, when you have momentum, this is characteristically an impulse wave. And when you have choppy price action like this, this represents a corrective wave most often. And what do we know about impulse waves? You know, they tend to be 1 waves or 3 waves or 5 waves. And corrective choppy waves tend to be 2 or 4. Again, this is not Elliott wave stuff in and of itself because that stuff gets very, very in-depth and, in my opinion, way, way, way too technical, as if, you know, the markets are an exact science which move on Elliott waves, which is not the case. But it does unfold in waves because of psychology. In other words, you get the initial sell-off, and now down in this area, traders are much more hesitant to step in and buy it because they're looking at this and they're saying, do I want to buy this? And the answer is a lot of the times no. And as it pushes higher, more people step in to short it because of this preceding it. So we have this sell off, the correction, and now we essentially have what looks like this kind of ABC, and then we sell off. Now this in and of itself is essentially a breakout of the correction because last week and prior weeks we took out the gold level, abnormal momentum. It shows that this corrective wave, when it does this and takes out the gold levels, it shows that's essentially failed, it's reversing. So now a really good opportunity in this kind of sell zone for this week, and we've got non-farm payrolls on Friday, but above the 160.80, that is where we start to become overbought intra-week, and that is very often where you see second waves peaking or bottoming after you get these initial reversals and these one waves in these markets. So keep an eye on those levels for euro yen to the downside. And again, once we take out this low, if we pull back and we start to sell off and take out this low, that actually kickstarts. This would be what would be known as if there's your first wave, there's your second. As you break this level, this becomes a third wave. But once you break this level, this becomes an even bigger third wave, and this becomes a second wave overall. And that's where you get monster moves in markets. Is it going to happen? Time will tell. I've gone through the reasons why this is very viable fundamentally. And now we're seeing technically we could have these major third waves breaking out in the Japanese yen pairs. If we come and have a look at New Zealand yen, you can see we had this very tight consolidation. And again, we get the big momentum on the initial yen shock. And look at how we failed to come anywhere near the highs in this market. That is indicative that this is likely to roll over with momentum to the downside and take out the prior lows. So the low in this case of that yen shock back in July and August. Now you can see again, we've broken out, we tested the gold lower level in prior weeks, and that is indicative also of the first kind of leg down after this correction consolidation. So in New Zealand yen this week, you can look for a breach of the 90.39. That's where we start to become overbought intra-week. And if we get into that zone, there's a very good chance we could start to see the peak in a reversal for the second wave down into the third wave. Again, we break this low, it turns into a much bigger third wave. And once we start to take out the lows of the initial yen shock back in July, really we could see this thing start to accelerate quite quickly to the downside. If we pull up US dollar Japanese yen, you can see again the yen shock, and then we snap back. And the dollar has been stronger than a lot of the other currencies during this time. But even the dollar cannot take out the highs of the initial yen shock back in July and August. And now look at this. For the first time since we bottomed down here and we started to make our way higher, for the first time we've started to get momentum in back to the downside. Everything else to the downside in this is just corrective. It's just choppy. This is real momentum. This is like an arrow pointing. This is the direction the market is now trying to go. So if we start to move back into the sell zone this week, it's above the 150, 189. That's where we start to become overbought intra-week. And as long as we don't take out this high over the next week or so, this can be looked at as a potential second wave. Of course, if we break this high, we get a higher high, don't we? So we get a new high. If you get a higher high, that means this is a trend continuation to the upside, right? So if we break this high, you can put an end to any potential third wave coming in. However, as long as we remain below this low, we can view this as a potential third wave developing. Once we break this, we can't. So as we start to pull back and trade above the 151.89 into non-farm payrolls, pay attention to this, because this is the area where we go into an overbought territory this week. And again, very often after tests of the gold levels, the first pullback above the blue level in this case often sets off a wave two, and you start to roll over the next week or so. Like with all the yen pairs, if we come down and we take out the prior low, this kickstarts a much bigger trend reversal to the downside, because this is a lower high, and as soon as we break this, we get a lower low. What is that? It's a trend reversal. A series of lower highs and lower lows is the definition of a downtrend in this case. Another market that's likely to suffer to the downside is Aussie yen. Aussie yen is the number one risk on, risk off Forex pair. And if we start to see risk off coming into the markets like we did the last time the Japanese yen exploded to the upside, remember we had a big, I think it was anywhere between 12 and 15% correction, you know, in any of the benchmarks, take your pick. And if we're going to start to see the yen strengthen again, this is going to put downward pressure on stocks probably after, you know, a Santa Claus rally, probably coming into January and February. And look at this setup in Aussie yen. We have a really nice reversal pattern here in the daily. We broke down, tested the gold levels as we were looking at, you know, in prior weekly Forex forecast videos. We test these gold levels. And now any pullback, especially if we can pull back into the 99.42, look at this. We're stair-stepping the confirmation breakout of the head and shoulders in the daily. And again, in this case, as long as we don't take out this high, every single sell-off or reversal pattern in this area has the ability to be the start of a third wave. Again, we take this out. This is where the momentum kicks up. You would expect it to take out at least this low. It could end up going much lower depending on how it breaks here and what the risk on, risk off conditions are in the overall stock market. Again, the yen actually has the ability to be the catalyst. In other words, it can rally and then that can cause risk off, and it kind of feeds on itself because you get a flight to safety in the yen, pushes the yen even higher as stocks sell off. And finally, we're going to have a look at CAD yen then. Why CAD yen? Because the Canadian dollar is likely to be affected by any incoming tariffs from the Trump administration. There's already been threats. It's already caused the Canadian dollar to sell off. And if we're going to see that implemented and we see the effects coming in with a weaker Canadian dollar, it's going to really give us a bearish catalyst on a currency like the Canadian dollar versus, you know, the Japanese yen, or at the same time as the Japanese yen is rising. So what I'd like to see this week is the upper bound here is the 108.67. If we start to enter this zone here, this is where we become overbought intra-week. And again, a breach of that this week would be consistent with a potential wave two, a reversal over the next week or so, and a third wave starting to the downside. Again, this would be something we couldn't look at if we break this high, because now we have a higher high, which means that this trend is actually continuing, and this cannot be a third wave to the downside if we take out this high. So it gives you, if you are looking to position into it, actually gives you a nice technical stop loss placement if you wanted to above these daily highs. Once we trade into this area, this is where, again, you can see very much like Aussie yen, we fail above this high, so we get a double top. We break it with momentum. That's your confirmation that we've seen the buyers liquidating. It gives us that direction. We pull back, we stair step, and again, that would be a great opportunity to look for that third wave down over the next few weeks, at least down to this low. And once we take out this low, who knows how low this market can go if we're going to get weakness in the Canadian economy. At the same time, we're seeing a repatriation of Japanese yen and another potential yen shock like we saw back in July, August. So that is it from me for today, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the GMT training room each day, where I look at the best markets as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge Hedge trading app used in today's video by heading over to www.hedge-.com. Access to the cutting-edge Hedge platform is included with every GMT membership.